All right, let's jump right into it. Have you ever wondered why the yen carry trade matters? Today, in this explainer, we're looking way past those flashy, loud headlines to examine what might just be the biggest hidden risk to the US economy right now. We are going to dive deep into a seemingly invisible, totally boring bond market dynamic that is actually secretly dictating your financial life. You know, it's a frustrating mystery, right? If you've been wondering why mortgage rates stubbornly refuse to fall or why the stock market just randomly freaks out every few months, you are definitely not alone. I mean, the Federal Reserve talks enthusiastically about cutting rates, but out in the real world, financial conditions still feel incredibly tight. The narrative we're being sold simply doesn't match the reality we're all experiencing. Well, get this. The answer to our mystery doesn't actually start in Washington, D.C. No, it starts all the way over in Tokyo. More specifically, it involves pretty much the most boring asset on Earth, Japanese government bonds. The country best known for anime and incredible food has quietly been acting as the financial duct tape holding the entire global system together for the past 30 years. And here's the scary part. That duct tape is starting to peel. To really wrap our heads around why this hits your wallet today, we've got to rewind a bit. Back in 1992, Japan's massive asset bubble burst. Real estate collapsed, equities tanked, and Japan entered what we now call the lost decades. It was this prolonged, painful period of practically zero real economic growth, no inflation, and flat wages. Out of options, the Bank of Japan did what central banks always do in a crisis. They cut interest rates to zero. And then, they cut them below zero. But when literally zero wasn't enough, the Bank of Japan broke out an extreme policy called yield curve control. They forcefully capped long-term bond yields, essentially super gluing interest rates to the floor, whether the market liked it or not. Think about what that means. It left massive Japanese institutions, we're talking life insurers, pension funds, huge banks, holding billion-dollar domestic portfolios that paid them absolutely 0% in return. So put yourself in their shoes. You're a massive Japanese fund facing zero returns at home. You have a tough choice. You either accept zero return on billions of dollars in cash, or you pack your bags and go shopping overseas to find any sort of yield. Naturally, they chose to go shopping. This kicked off a multi-decade global shopping spree where Japanese capital just flooded international markets in a desperate search for returns. And this aggressive hunt for yield, it completely rewired global finance. Through this relentless buying, Japan became the undisputed #1 foreign holder of U.S. treasuries. They became massive buyers of U.S. mortgage-backed securities and ultimately the world's largest net creditor nation. To put in plain English, Japan became the world's ATM. Okay, so how did this ATM actually work in practice? Let's use a hypothetical investor. We'll call him Bob. Bob goes over to the Japanese market and borrows money in yen at a near zero interest rate. He then converts that yen into US dollars and buys US treasuries, yielding, let's say, 4%. After a few minor hedging costs and fees, Bob just pockets the difference. That exact mechanism is the famous yen carry trade. You're literally borrowing money for free to buy stuff that pays you. But wait, because investors definitely didn't stop at safe US treasuries. I mean, when your borrowing costs are basically zero, you buy everything. Investors use this unbelievably cheap yen to load up on tech stocks, real estate, emerging market assets, you name it. At its peak, banks estimated this yen carry trade was worth trillions of dollars. It was a historic source of global liquidity. I heard someone describe it recently by saying the global markets were running on Japanese Wi-Fi, and that analogy is just absolutely perfect. But here's the catch. This entire setup relied on one incredibly fragile assumption, that Japanese yields would stay near zero forever, and that is exactly where the dominoes start to fall. In 2024, that assumption broke. The Bank of Japan finally ended its yield curve control policy and raised interest rates for the first time in 17 years. Suddenly, borrowing yen got expensive. Hedging currency risk got expensive. The math completely flipped on its head. The free money era was over, meaning all that capital was about to aggressively U-turn back home. And man, the moment that math flipped, the markets officially freaked out. Right after Japan's second rate hike, we saw some brutal single-day drops. The S&P 500 dropped 6%, and Japan's Nikkei index plummeted over 12%, literally its worst single-day drop since 1987. This was the shockwave of repatriation. Trillions of dollars that had flowed out of Japan for decades were suddenly being yanked back home. So here is the absolutely crucial takeaway from all of this. For decades, Japan wasn't just some random player in the market. They were one of the most consistent, price-insensitive buyers of long-term U.S. debt.
Now that the cheapest source of global liquidity isn't cheap anymore, Japan is stepping back, and them stepping back fundamentally threatens the entire flow of global money. Legendary investor Ray Dalio actually hit the nail on the head here. He points out that the bond market is the backbone of all markets because it determines the risk-free rate that dictates literally all other asset returns. When the supply and demand for bonds breaks down, it completely reshapes the financial landscape. Long-term rates rise, and suddenly central banks everywhere are caught in a massive bind. You know how everyone obsessively watches every single word Jerome Powell says at his press conferences? Well, they're kind of staring at the wrong lever. The Federal Reserve really only controls short-term overnight rates, but the long end of the yield curve, the 10-year, 20-year, and 30-year yields that actually dictate what comes out of your wallet, those are driven almost entirely by supply and demand. They're driven by who is actually willing to step up and buy the debt. And let me tell you, the supply side of that equation right now is staggering. The U.S. is running trillion-dollar deficits year after year. The Treasury has to issue a massive mountain of new debt just to keep the lights on. Well, as this debt issuance keeps ballooning, someone has to absorb it. With Japan backing away from the absorption machine, yields simply have to rise to attract new buyers. So when long-term yields have to rise to attract those buyers, while the Fed is busy cutting short-term rates, you get this thing called a steepening yield curve. And if those long-term rates stay elevated just because Japan isn't buying anymore, it stops being a boring bond market story. It becomes an everything story. It brutally punishes the average consumer and investor, and it does it in three very distinct ways. First up, it hits the stock market. Now, this sounds a bit technical, but think of it this way. When financial analysts value stocks, they measure future profits against long-term bond yields. When those bond yields stay high, those future profits look way less valuable today. That means stock valuations shrink. So even if a company is doing great and their earnings are totally fine, higher long-term yields force analysts to value those earnings for less, which causes stock prices to just drop out of nowhere. Second, and this one definitely hits close to home, we're talking about mortgage rates. Mortgage rates are not anchored to the Fed's short-term rate. Not at all. They are largely anchored to the 10-year Treasury yield. So as long as global demand for U.S. Treasury stays weak without Japan's help, that 10-year yield stays high. And that means your mortgage rates won't magically drift back to 3% no matter how many times the Fed cuts rates. Housing affordability stays strained, and nobody wants to move. Finally, it attacks corporate credit. And corporate credit is literally the bloodstream of the business world. When capital was virtually free, companies issued debt like crazy to expand, hire, and grow. But when long-term borrowing costs stay elevated, that corporate deal flow totally dries up. Risk appetite plummets, capital tightly constricts, and overall economic growth heavily slows down. It changes the cost of money everywhere. Now, I can almost guarantee you aren't hearing about cross-currency carry trades or Japanese capital reallocation on the evening news, right? Why? Because it's just not clickable. Explaining the actual plumbing of global finance takes patience, it takes nuance. It's so much easier for the media to sell the lie that one rate cut from the Fed fixes everything, rather than trying to compete with loud viral headlines about AI or Nvidia stock prices. But here's the thing. Those loud threats, they are usually already priced into the market. The real threats to your money are the boring ones, hiding right in plain sight. For 30 years, the U.S. got to benefit from being on the receiving end of the world's largest carry trade. But now, that liquidity is tightening up, which leaves us with one pretty terrifying question you really should be asking yourself today. What exactly happens to the global financial system when the world's ATM finally stops dispensing cash?